Delia, good to have you
morning.
back. Good morning. Last week, why don't you give us just a little bit about a 5-minute overview of what we covered last week?
Well, we covered some of the basics, of course, of financial planning, goals and objectives. You really need to know what you want to accomplish, how long you're going to invest money, how much it costs you to live, what your spending needs are. These are the fundamental basic building blocks of doing a financial plan. If we have that information, we can start to fill in other details, including we need you to put together a balance sheet or a net worth statement. How much are you worth? How much do you have available for emergencies? How much do you have available to invest? What do you have now in investments? What's your house worth? You know, what do you owe and at what interest rate? Your net worth gives us so much information. And never forget to include how these accounts or properties are titled. People often forget that part. Now, I'm wondering if, I'm seeing Gary reconnecting. I'm wondering if this is a good time to touch base with Gary.
Okay, I think
That's
so.
exactly what I was about to say. There you go. Hi, Gary.
So let me stop this for a minute.
Gary, I gave a brief interview or brief update on the Pacific Symphony, but why don't you talk a little bit about it and welcome back. And I'm sorry you had a few problems.
Well, thank you, Pete. You can see, today is an unusual day. I've got a coat and tie. We have a live concert tonight, so we're really excited about that. And I think I just got overwhelmed with too many laptops to work from.
You're sounding, at least on my end, like your major feedback on your audio, but I don't know if that's true on everybody.
I'm
Delia?
not hearing that.
Okay, good. Then it's just me. So go ahead, Gary.
No, we're delighted to be sponsoring the session again. Our subscribers and donors have really appreciated, and I'm sorry to interrupt the flow of the meeting with the technical problems. As I said, the symphony is back full-time at the Segerstrom Center. It's been an unusual year, unlike any we've ever had. 2 weeks ago, we had our first concerts there. Very emotional for nearly all of us in the audience, and of course the musicians on stage as well. This had been the longest hiatus without hearing or performing music, which is their livelihood, in our entire lifetimes. So you can imagine how special that evening was. I think these concerts this weekend will be equally special.
What are you having this weekend, Gary?
Tonight, tomorrow night, and Saturday night, Carl St. Clair is conducting a wonderful program that features the Eroica Symphony, but also the world premiere of a piece that Carl commissioned 3 years ago, and we never got a chance to perform it for his 30th anniversary. And it's called it's called All the World's a Stage. And it really is a concerto for audience and orchestra. So the audience has participation in this piece. And if you're there one of these 3 nights, you'll be one of the very first performers to do it anywhere in the world. And you can say you've played with the Pacific Symphony.
So if anybody wants to have tickets tonight, what would they do? Just go to the website or?
Go to our website. There are good seats available. After a year and a half, it's taking us a while to get audiences back, but what we hear overwhelmingly from people in the lobby are comments such as, I didn't realize how much I miss being together with friends and listening to great music.
Yeah.
And the other thing they tell us is that, you know, we understand the safety protocols, but once we're seated, we totally forget that we're wearing a mask and just enjoy the music. So I hope everyone will come out.
Thank you, Gary. Really appreciate you. And sorry about the technical problem.
No, my
always a hassle.
I think it's, you know, putting a tie on probably is affecting the oxygen flow or something.
Yeah, yeah.
Sorry
But
to interrupt you, Delia.
yeah, no, what the Pacific Symphony does for the community is kind of like a blood for the body. You know, it makes us whole, it makes us live. So I'm so happy that the Pacific Symphony is here. And thanks again, Gary, for your support.
Thank you.
Okay, take care. All right, let's go back to money.
Oh, money. Money, money, money. So again, we really, really want you to have gone through the work of putting together your net worth statement and titling each asset. You know, we forget if you're just a single person and you don't own property with anybody else, it may seem like a non-issue, but if you are part of a couple, you know, sometimes your accounts can be joint, sometimes your accounts can be individual, sometimes they can be owned in your revocable trust. And sometimes they could have a transfer on death or pay on death, which is true of all of us. We might have taken our trust account or our brokerage account and said, you know, if I pass away, here's who it goes to. Well, that needs to coordinate with everything else that you have as part of your estate plan. So we need to pay attention to those things because a lot of times they're out of date and they need to be updated.
Yeah,
So,
one of the good things about you, Delia, you're a good nag, you know.
absolutely.
You know, so a lot of times people put off putting their estate planning needs off, you know, sometime in the future. The other thing that's really important, I think, from a financial planning point of view, is that when there is a death in the family, the last thing that people want to deal with is all the money issues. And you need kind of a fee-only advisor that I can recommend as to just to keep that part stable, you know, that because you're in a state of shock and when there's a death in the family and you need someone there to say, hey, I'm the best interest. I'm not going to try to sell you. I'm not trying to take advantage of the situation. I'm going to try to help you through the process. One of the things that I love too about fee-only advisors such as Delia is that they can serve in your estate plan as the trust protector. What does that mean? It means that the fee-only advisor can hire and fire the trustee. And that person, now you've got another person kind of overseeing your estate and your money. And it's and they know you and they've been with you for a while. So it's something to consider. The other part too that you mentioned last time, Delia, was taxes.
Yes.
And you mentioned insurance.
Yes. The importance of having the right amount of insurance to cover your net worth. That's why we start with a net worth statement. We figure out what we have to protect. And then we take a look at your auto and homeowners insurance to determine if you have enough liability insurance so that nobody takes away any of your net worth. We figure out whether you have enough coverage on the house. So if it, heaven forbid, it burned to the ground, that you could rebuild it. And we often find that clients would be best served by having a third policy called an umbrella, personal umbrella liability policy.
Okay, let's go into today. We're going to talk about investment planning. And what's the definition of an asset class?
An asset class is a category of investment, and oftentimes that category may act a little differently than another category. It may actually have a little negative correlation to another asset class.
Ooh, you just used another word, correlation. What does that mean?
Correlation means how they move in the same market. Do they all move the same? Well, that's just the same correlation, but do they move differently? So for example, a lot of times stocks and bonds are negatively correlated. If the stock market goes up, bonds can go down. If stocks go down, bonds often go up. That negative correlation gives you protection in different kinds of markets.
So the first thing people need to do is understand what they have, and they figure it out by percentages. How much cash or equivalents do they have percentage-wise of their net worth?
That's it, versus bonds or stocks or other kinds of investments. Exactly.
And when you say alternatives, what does that mean?
An alternative could be.
I think you have a slide on that.
Let's go take a look. So let me make sure my pointer is in the right place. So these are
Or,
cash.
you know what? Let's just go through your outline the way it is. Because
Okay.
it's going to be too difficult to jump around.
Yeah, it is kind of strange, isn't it? We're not
Yeah.
flipping pages.
Yeah, so let's talk about cash and equivalents and why is it important to have?
Oh my gosh, cash is there when you need to spend money right now. You blew a tire, a tree went through the roof, whatever it is. And these are things, cash and cash equivalents are things that are, you put in $1, you get back $1, absolutely safe, oftentimes, ideally insured, FDIC insurance, NCUA insurance through a credit union. So this could be a deposit at a bank or financial institution, might be a contract with an insurance company, certainly could be very short-term US Treasury bonds because they don't fluctuate in value if they don't go out very far in maturity. Say they are only 6 months and they mature. So oftentimes we call these stable value investments. They may or may not keep up with inflation, but the cash is there when you need it.
So what do you recommend, or is there a general rule of thumb as to either what percentage or how much cash should you have available?
We often think of cash as an emergency fund, and in general, financial advisors would say 3 to 6 months worth of your basic spending needs, but that is often calibrated for people who are working. So they might lose their job. For the rest of the world that may not be working, you may already be retired, then I like to customize it. I like you to sit down and figure out, well, I have some things that come up every year that I need to put money aside, and the washing machine's making a weird noise and it always talks to the dryer. You calibrate that, and oftentimes it's a matter of personal comfort.
I was just going to mention that. Some people don't feel comfortable unless they have at least a minimum of a year.
That's exactly it.
And comfort is such an important issue. You can't underestimate it because you've got to, a lot of times Delia is like a coach. She's trying to coach you along to do the right thing. But at the same time, if your comfort zone is a year, she's going to listen to you.
Yeah, we have to do that because so many people in retirement are relying more and more on their investments to help them with everyday income. So, as Pete often says, if you're relying on only pensions and Social Security and you have such generous pensions that you don't have to worry about your investments, you're in a very special place. But for a lot of people, most of my clients, they may not have that big generous pension in retirement. So they're looking at those investment accounts to be able to tap them and give them income. And that means they need to have some money set aside for emergencies or they just don't feel safe.
Yeah. And a lot of times people use terms like good or bad as far as investments are concerned. So I think a better way to look at investments is that they have advantages and they have disadvantages. So one of the disadvantages of having cash is what?
Not making any money.
Yeah. It's not inflation protected.
Yeah, you drive around and you hear the market's up, or inflation adjustment on Social Security just went up 5.9% yesterday, announced, but your cash didn't go up. The banks don't seem too eager to give us interest.
Yeah. So you're going to hear us to say, hey, rule of thumb, 3 to 6 months to have cash, but it doesn't maybe apply to you as an individual. And if you hold more cash, it's not that it's bad. It's just that cash is not keeping up with inflation.
And we need to remember for retirees, one of the number one threats of retirees is inflation.
Yeah, I remember going to the theater and it was $3 to $5, Yes. I haven't been to the theater in a while, but it's $12 to $15 today.
Yeah, I remember when movie theaters were turned into double-digit tickets, and I'm like, what?
Yeah,
What?
I didn't know there was going to be like I thought it was always an inexpensive date, but no
Exactly.
longer.
Exactly.
Okay, let's go through the next slide.
So here we have that next level up from cash. And now we're going into bonds. And bonds are when we lend money to either a government, a local or federal government, state government. We lend money to a company. And we typically will get an interest rate back. We will get paid interest for lending money to them. And we calibrate these bonds in part by both the quality of the entity that we're lending money to, but also by how long those bonds are. Is it a 6-month bond?
What is the safest investment in the world?
US Treasury bonds.
Okay, and why is that important for people to know as to what are the safest investment bonds in the world paying?
Because it is a benchmark for every other, not only every other bond, but every other investment in the world. I'm actually really kind of proud that when I get up in the morning, the market is talking about worldwide, they're talking about the interest rate that the 10-year Treasury pays. That's what they call it, is the 10-year Treasury bond. They refer to it as the 10-year Treasury.
And what is that rate right now, approximately?
It's about 1.4, 1.5%.
And it's a good thing that they raised the debt ceiling?
Yeah, because everybody's a little bit more relaxed about where the US is going and the quality of US management. Yes.
But we all have different thoughts about how the US government works.
Oh, yes. Whenever I mention it, I can see some people rolling their eyes, and I don't blame them because it's a messy system.
Well, it's kind of like watching hot dogs being made. I don't think you would eat one if you knew exactly what went into it. It's the same thing, though. The US government treasuries worldwide, worldwide, is considered the safest in everywhere. From China to Russia to you name what country, they look to the US treasuries as being the safest.
And when investors speak to each other, when professional investors speak to each other, they talk about what amount of risk parity, risk return over the 10-year Treasury you're going to get.
Yeah.
That's their benchmark.
Yeah. So in order to get more than the US Treasury rate, you're going to have to take more risk.
Yes.
Okay. So that's really important. Why? It seems like short, intermediate, and long-term are common English definitions, but in the bond market, what do they mean?
Short-term can be anywhere from 1 to 3 months up to about 6 to 7 years, but mostly 1 to 3 years, I would think would be absolutely short.
What does that mean to someone's portfolio?
It means that it's not going to be very volatile. Most of us like to get a return, but we don't like the wild ride. We don't want to take Toad's wild ride.
So again, when you talk to another financial advisor or another person in the financial services industry, and you talk risk, is that what you're referring to? Is volatility?
It's one kind of risk. I tend to think of two kinds of risk: the risk that the ride is going to be really rough, volatility, and the risk of absolutely losing money. And it could be that you won't lose money, but the ride is really rough. And if you can't stay the course, then we don't have an investment plan that fits you, right?
Do people like volatility?
No, absolutely not.
So the bonds in a portfolio, one of their purposes is what?
One of their purposes is to not only give you income, but to also counteract the volatility of stocks.
The correlation.
The correlation, to give you negative correlation to stocks so that your whole portfolio, your top line is less volatile. Top line, the whole dollar amount of what you've invested in, bonds and stocks.
So what does intermediate mean?
That's about 5 to 7 years. And it kind of spans a little bit over that, but that's
intermediate. So intermediate would be between 5 and 10 years, or it would be?
It could be up to 10 years, right? It could be up to 10.
And long-term is?
Over 10, usually over 10 to 30 for US Treasuries. There are some corporate bonds and other bonds that might go out farther than 30 years, but it's really not common.
About 20 years ago, long-term bonds were paying 8, 9, 10% returns. Do you put people in long-term bonds today?
No, absolutely not. You know, if you think about it, we don't expect interest rates to go down from here. We expect them to go up. And if interest rates go up, then all those bonds that you have are looking like so yesterday, right? You need to toss them out and get new ones. Well, the ones that are the most hurt are the ones that would require the longest commitment. You know, who wants to lock up your money for 30 years to get less than 2% interest?
So for everybody who's watching this, one of the things that they need to do is that most people have bond funds. And so they need to look at their bond funds and figure out, is it short, is it intermediate, or is it long? Because you're not putting anyone in the long, right?
No, no, and you
how
might
about
find that a lot of bond managers are going shorter and shorter with their maturities because they're afraid of interest. They know interest rates are going to go up.
So do you even have your clients in the intermediate bond funds?
It might be called an intermediate bond fund, but I'm going to take a look at that average maturity and make sure that it's shorter than the average.
Okay. So these are terms of art. You need to understand them so you know what you have. Don't make any changes yet, but you need to understand what you have. Let's talk about the risks, because there's risks in every investment.
Absolutely. And we've just been talking about inflation risk with interest
bonds
rates.
Don't give you that, correct?
No, most bonds do not. There is a type of US bond that moves with inflation. That's called a Treasury inflation protected or inflation adjusted security. We abbreviate it as a TIP. Those do move with inflation, but in a mutual fund, they can be overbought and overpriced. So you have to be careful about that.
Just remember, we're not going to go into the intricacies of bonds because we have an entire hour and a half that we're going to do on fixed income.
Which is
so
just
this
excellent.
Is kind of the top-down overview of the bond area so that you have some of the vocabulary and an introduction to this area. What does it mean by market risk?
Market risk is really taking a look at the quality of the borrower and what's going on in the market. So it might be that you have a lower quality bond and the market is not excited about low quality bonds. They're looking for more quality bonds. It might be that the market itself is changing and you're just seeing some volatility. You have to assume that if you're owning any kind of security in any given day, it can move up and down.
Company performance, is that you're referring to Sears bonds?
Sure, exactly. And Enron bonds and anything like that where, you know, it's just like if you and I were thinking about borrowing money from one another, you know, hey, Delia, you know, could you lend me $20? And I'm thinking, well, now how good is Pete's credit? Is he good for that $20?
You see me how I spend my money, so.
But it's like, you know, you may have friends that you feel comfortable with, but if they asked you for money, you're doing that quick calculation of what's the risk that, you know, am I going to get repaid? And that's what company performance risk is how good is the borrower? What's the likelihood that you're going to get your money back? And you will find.
Yeah, and the longer you go out, the less likely it is that you're going to get repaid.
That's exactly it.
Yeah.
So, you know, the longer the bond, the higher quality you want the lender, the borrower, sorry.
Okay, let's go to the next slide. Okay, stocks.
Yeah.
Sometimes, okay, bonds are sometimes called fixed income.
Yes.
Investment planning with stocks is sometimes called equity. Why those terms?
Fixed income is because a bond is typically issued with a fixed interest rate that they're going to pay on the bond. So we think of it as fixed income, reliable income. Equity, you own a piece of a company. You know, when I walk through Disneyland, if I have Disney stock and I see some paper on the ground, I'm like, hey, clean this up. You know, I own a part of this. It's just like the equity in your house. And that means you get to participate in the growth of that company. You also get to participate when it goes down. So it
as
is-
an owner, you should expect a greater return.
because you're taking more risk.
Okay.
That's exactly it. You're participating in the performance of that company. You should expect more risk, and you should expect more return for that risk that you're taking.
Okay. So having equity in your portfolio means that you got now a little bit of inflation protection.
Yes, yes, absolutely. And again, this is what retirees need to think about is what is their portfolio doing to beat inflation or help them at least keep up with inflation. And that's the big role that stocks play. That's absolutely the role they play.
So it's like whether you're Verizon or Amazon, they can increase their prices to maintain a profit no matter what inflation is doing.
That's exactly right. And if you own a piece of it, then you're going to benefit from that too. You hate it when you go to buy something that the price has gone up. And so part of the remedy to that is to own the companies that are raising the prices so you can participate on the other side as an owner.
Yeah. Principal risk, what do you mean by that?
That means that you could lose some money.
Okay. And market risk?
The market is roiling and you're going up and down with it.
Okay.
Because
then, of
you,
course-
no matter what you buy, if the whole market takes a dump, you can't control for that. You can't diversify away from market risk.
Okay. Then there's company performance risk.
Yeah, company may not have the sales that they need to have. They may not have the profits they need. And the market punishes them when it doesn't look like they're performing well.
So the antidote to many of these issues that of risks is diversification.
Absolutely. You don't put all your eggs in one basket.
Just like we're not going to do all one bond, we're going to have a variety of different bonds. The same thing in the stock market. We're going to have a variety of different kinds of stocks. I think you have a slide that talks about all the different categories of stocks.
Yes.
Okay, well, let's go through the alternatives first, and then we'll go back to the other.
So alternatives are those, again, we're looking at that word correlation, and we want things that move differently than stocks and bonds. So these are non-correlated assets that really make things a lot smoother. They reduce the volatility of your overall mix of investments. So that could be commodities, it could be pork bellies, and it could be oil and gas. It could be hard assets such as silver and gold and other minerals. It could be hedge funds, which invest in a whole range of things. Sometimes we know, sometimes we don't. It could certainly be real estate. For those of you with rental properties, you know how that feels to know that you have a piece of real estate. Venture capital, where firms are supporting new companies that are just beginning to grow and thrive. And then private equity, who knows where they're going, but that's where you invest directly into an entity as a private investor, not something that trades on the open stock market.
Okay, in the alternative area, I always think of the commercial where they have the professional driver, with a helmet and being filmed and going 90 to 100 miles an hour around curves, and they have a little print on the bottom of the screen saying, these are professional drivers, don't try this on your own. It's kind of the way I feel about alternatives. For the average individual, they're more than likely not needed. And there are alternatives on the US stock market, i.e., if you wanted to do hard assets, you could have a small portion of your total portfolio in mining companies that pay a dividend and as well. If you like real estate, there's real estate investment trust that you can purchase.
Can they be done within, Pete, can they be done within a mutual fund?
Yes.
So I could have hard assets in a mutual fund or something like a fund that covers hard assets.
Exactly. And the beauty of that is that if you, for example, if you venture into a private equity, can one of the tenets of a good investment is understanding how you get out of it. If you go into a private equity deal, how easily is it to get out of that private equity deal?
No, it's not. They're going to have restrictions on when you can sell or if you can sell. And they might even have requirements that you put more money into the deal on some regular basis.
Yeah. So the alternatives is for the individual that it has a very high net worth, that can afford to wait a long time, and you really have to have somebody there who understands what's going on and the fees, because these are highly laden with fees
Yes, they are.
because they're alternatives. So don't get enamored with hedge funds or venture capital or private equity. They're for people who can afford to lose money. And for most of us, the stock market is the best thing because it's liquid. How important is liquidity?
It can be extremely important. Nobody wants to get locked into a deal that they can't get out of unless, as you say, they've got a bunch of extra millions of dollars and they're not really dependent on this money. Some people who are in the alternative field will say, well, you prioritize liquidity too much. And I'm like, yeah, no, not for my clients. We all like liquidity. We all like the ability to change our minds within, the hours that the market is open and make a change.
Yeah. So just this is the sexy stuff that, nice articles. I mean, it makes news. Be very careful going into alternatives. Let's go to the next slide, Delia.
So here we are.
Individual stocks.
Sometimes I think, although we're probably in sync here, where we like diversification and we like a broad holding. Sometimes people are so enamored of individual stocks that maybe they want to set aside a separate small account to play with individual stocks, but I wouldn't rely on it for all of your plan. But that's when you get to go in and buy shares of Disney or Apple or Google or whatever it is, Alphabet. But I'm more likely to look for a client for true diversification to go into a fund, whether it's an exchange traded fund, which gives you a whole variety of, it trades like a stock on the stock exchanges, but
well, you don't have index funds on this slide. What is an index fund first? And then let's talk about ETFs.
An index fund is something that buys stocks or bonds that track an index that we can compare it to. So we all hear about the Standard & Poor's 500 or the Dow Jones Industrial Average. You can buy a fund like an exchange traded fund or a mutual fund that tracks an index. And the philosophy is, if you can't beat the market, you buy the market. It's considered passive investing.
Yeah, those are all terms of art that you're going to be hearing throughout the rest of the series. Delia, are you a passive or an active philosophy when it comes to investments?
I am mostly a passive investor because I get really low fees. I get strong diversification for my client. And frankly, I get market returns or better because the market's doing well and I've got most of my clients' money working for them really hard.
So what's the difference between an index fund and an exchange traded fund?
Well, actually, the index fund is talking about what the holdings are like, that it is replicating an index of a certain type of or part of the market. An exchange traded fund is one way to buy an index fund. It does not necessarily have to be only index funds. There are a few ETFs that are coming out that are actively managed, but that's another vocabulary term.
Yeah.
But an ETF is something that trades like a stock during the day. And it gives people the satisfaction of being able to go in and say, now I want to buy something at this price at this point during the day's market. It can be very satisfying.
Okay, so an index fund, you're buying the index so that you're not paying the investment manager to analyze a Disney or an Apple and trying to predict what's going to happen in the future. It's pretty simple. So one of the key components of an index or an exchange traded fund is that they're really cheap.
Yes. And that's what they compete on. They compete on their ability to track the index. If they don't track it well, then they're out. And they compete on price. The internal fees and expenses to manage that fund are going to be rock bottom. And it's not what you make, it's what you keep.
And it's also why is it tax efficient?
It's tax efficient because if you're using a very broad-based index, like the Standard & Poor's 500 of the 500 largest companies, well, the Standard & Poor's company doesn't change that mix of stocks very often. So you're not having a lot of buying and selling inside the fund. And it's that buying and selling that pushes through capital gains to you and other taxable impacts that you may not want to have in a taxable account.
Yeah. So we talked about mutual funds in the second session, but we didn't go into the defining those mutual funds as much. But just general overview, make sure these mutual funds are no load, have low expense ratios, and you understand the objective of the manager of that fund. Let's go to the next slide because we're going to talk a little bit, I believe.
Here's our active and passive.
Pete, wait, I want to go back up one slide if we could. But there's something that Delia said a minute ago that I want to come back to. If I'm buying a stock or if I'm using an ETF fund, I'm saying I want to buy this stock at this price midday.
Yes.
If I buy a mutual fund, I don't do that. The price is determined at the end of the day. So you can't say, I want to try for intraday profits or something in a mutual fund because they only value after they close. Correct?
Correct.
That's right. And there's another point too, is that if you're trying to hit a particular dollar amount of investment, I want to invest all of my $4,000. You can do that with a mutual fund because that's how you buy it, is by dollars. An exchange traded fund, you buy it by share price, the way you do a stock. So if my share price doesn't divide evenly into the 4,000, I may not be able to put the whole 4,000 to work.
I want to ask one question, and it's out of order from where we are, but it's because it's in the chat, I can't respond to it. So Delia, let me ask you a question. We have people who are doing a Zoom call because they're around the country. Will you take on clients virtually?
Yes.
So they should just go ahead and contact you regardless of whether they're in Poughkeepsie or I don't know.
Yes, they could if they wanted.
Okay.
I'm a California advisor, so I have restrictions on Texas and Florida, but that would be.
There's a lot of things that are restricted in Texas and Florida, so I don't blame you for that. Anyway, I just wanted, because that was in the chats, I couldn't ask, and I wanted to cover it now. Thank you. Bye.
No problem.
But I want to follow up on a couple of points that Don made, if I can remember them. One of the things about an ETF is that they trade during the day. We're going to get into session 8, how much the mind prevents us from being good investors. And one of the things that I kind of say, leave the ETF buying and selling to the professionals, because the last thing you want to do is buy and sell. You know, it's the Warren Buffett. You need to hold on to your investments 3 to 5 years. You want long-term capital gains. Lots of good reasons why you want to put a portfolio together and not change it, you know, and an ETF is easy to change. So yeah. I like the ETFs for the professionals, index funds for us who are amateurs, who don't look at the market every single day. let's go to the next slide because I think we're talking about active and passive. So briefly, just kind of go through this.
So again, active is going to be where you have mostly mutual funds. There are a very handful of ETFs where you have a manager of that fund who is trying to move in and out of the market in a certain category to get the best of that category. So they're not buying the S&P 500, they're cherry picking some of the stocks maybe in that area. And so there may be higher costs, more trading costs, higher management fees. That buying and selling in a taxable account is not what you want because they have to push out by law any capital gains that they have, any gain on a sale that they make. They have to push that gain and the tax obligation out to the shareholder. So
And
you are
passive-
on the hook for that.
And passive is?
Passive is just owning an index, just replicating a category of the market. And the broader that category or index, the less buying and selling inside and the lower the tax hit on you in a taxable account.
Yeah. So Warren Buffett recommends index funds for most people.
Absolutely.
Absolutely. Yeah. Unless you spend an enormous amount of time on being an active manager, you're probably not going to beat the market.
No.
Let's go to the next slide.
So we've been talking about this.
Yeah. Why is diversification so important?
Because we don't know what's going to happen in the market. We think we might know, but we're being foolish because things happen. We didn't know the start of last year in February that we were going to shut down the economy in March because of a pandemic. And because you don't know what's going to happen, it's best to have your eggs spread out and diversified, not all in one basket, not all in one category.
So when I hear people talk about a particular investment and risk, no one mentions how important. I am totally diversified. No matter what happens in the market, I'm going to be okay. I hardly ever hear that, either on a news show or in cocktail parties. But it is literally the key to being safe. And people don't really understand it. So let's go through some of the categories of understanding in your own portfolio what it means to be diversified. What does domestic mean? US stocks or US bonds, but we're talking about diversifying stocks. So it would be US stocks. So does US have the vast majority of companies in the world?
No, it doesn't, but it's the one that we know, right? And it's the one we hear about all the time in the news.
So when you say international funds, that's even broken down into two areas. What are those?
That is developed countries, the big guys, the Germany and the France and the England, and the emerging markets, the groups we used to call the third world countries. Asia, Taiwan, Indonesia, China, India, South America, Mexico, Central America.
And how have they been performing in the last 5 years?
International has not done quite as well as domestic. And so we like to say that they're on sale. And companies such as Vanguard are putting a lot of their money allocated towards international stocks when they allocate money in a portfolio.
So individuals.
But a question though, but if you're looking at a domestic company, Coca-Cola, General Motors, it doesn't mean they only operate in the US. They could be an international company. They just happen to be headquartered here.
In fact, probably their revenue is probably more international than they are domestically.
It certainly might be.
Yeah, but why though is this important in a portfolio when you're looking at mutual funds?
Because when you look at a mutual fund, they have the ability to go out and choose to do the research and do the investments overseas that you and I probably can't do very efficiently or cost effectively.
And so when you're saying international funds, that manager for that particular fund can go outside the United States registered companies.
Yes, absolutely.
So
Absolutely.
whereas if you did just domestic companies, yes, you could buy a Coca-Cola or a other companies that sell internationally. But talk about why is it so important to understand the objective of that fund?
Well, because you may wind up buying something and owning something that you didn't know you were owning. You know, when it doesn't perform like you thought it should perform, when you open up the fund information and then you look at it, you say, oh, well, I didn't realize they were 40% in emerging markets, or I didn't realize that they were actually a global fund and they only had 30 or 40% in US and all the rest of it was international.
So in order to achieve proper diversification, when you put percentage of, you really have to understand the objective of the mutual funds or the index fund that you're purchasing.
That's exactly right. That's
Okay.
exactly right.
What is what is growth versus value funds?
This is a way of identifying a category of companies based on their profit and growth of earnings patterns. So a growth company is one that grows greater than average, much more profitable. We're thinking about large growth companies such as Netflix, Amazon, Alphabet, Google, Microsoft, those large growth companies, which make up a great deal of the S&P 500.
But there are managers that just focus in on growth funds. Are growth funds better than value funds? And what is a value fund?
A value fund is a stock that may not be growing in terms of sales and profits as much as the traditional growth category, but they definitely have their time. For example, today the market was started out very excited because the value funds that are the financial companies, so that value investment really came out with some great profits. We're in the middle of profit reporting season. And so the value stocks in that category are doing very well. At least they were a couple hours ago.
Okay, yeah, you never know.
Never know.
So when you put the portfolio together, you make sure that if you are going active, that you have both growth and value in the portfolio.
Yes, because you don't know where the year is going to go. You just don't know.
Yeah. So high price earnings ratio, low price earnings ratio, is that something that the average consumer needs to know?
We may not really care unless we're buying individual stocks, but it does help define what the category is.
Okay.
You know, it is a measurement that Wall Street uses. How is the price as a ratio to the actual corporate earnings? And they put a value on it. And if it has a high price earnings ratio, well, you expect it's there because it must be doing better than other stocks. It must be growing faster. It must be more profitable. And it may show us that in the future, it's going to continue to be that way. So we may decide we want that category.
Can you compare a growth manager with a value manager?
I would compare them only by their category and not across categories, because
Right.
you're buying it for a particular reason.
Yeah. So apples and oranges.
Yeah, absolutely.
And not one is bad, not one is good.
No,
So, yeah, it depends on your portfolio, how much risk, your philosophy. Let's go through one more item that's really important, how this diversification works. What does small cap mean and large cap mean?
this is really talking about the market capitalization. How many shares of stock are out there in the stock market based by size? So a large company generally has more than $10 billion of stock out in the market. Large cap says large capitalization stocks.
And why is that important to understand?
Well, because it's a critical mass. It shows how strong the company is. It shows how prevalent
they can go through a recession.
Yes, when we saw the market go down last year in March, when it started coming back, we saw Wall Street really focusing on large caps, companies that they thought would survive a shutdown of the economy.
So you have a slide in here that shows historically how these different market caps work. Yes. Talk a little bit about this chart and why is it important?
Well, it's a very famous chart, first of all, by a gentleman named Ibbotson, who went back from 1926 on and looked at different asset classes, size of companies. And
because they act differently, right?
Because they act differently and because they give us value over and above inflation. Because this is what we as retirees have to worry about, is if we're retired, we have to make sure that we're making some money over and above the continued increase in the cost of living. So you
have a chart here that says inflation.
Yes, the gray line, which is that bottom line, inflation has averaged from 1926 to 2018, 2.9%.
So why, knowing 2.9%, why is that important? I mean, what difference does it make to me if I know what my inflation rate is today?
Because we need to know what we have to do in order to make a real return on your money. If your boss called you in and it was 2.9% inflation and said, you're doing such a good job, I'm going to give you a 1% raise. Well, you're going backwards. You're not moving forwards. You're not keeping up with inflation or beating inflation. And we need to protect your buying power.
Yeah. And the other thing too is, how would you know if inflation is high or low if you don't understand what the historical rate is?
Right.
This is what gives you that reference point as to how these different asset classes are doing. Treasury bills, historically 3.3. And you mentioned that right now on Treasury bills are doing what?
Well, this is a bill is technically one that only goes up to 1 year of maturity. And I can't even tell you because it's worth so little, but a 10-year Treasury is about 1.4%.
Yeah, so right now Treasury bills are paying about 1%. So historically, we could expect that to go up.
We could expect it, but in the last couple of years, you could argue that maybe they haven't even kept up with inflation.
Yeah, and then we have government bonds.
So you're getting maybe 2.6% over and above inflation in the long run, but I would say similar to treasuries, they haven't paid that much more than inflation.
So you as a professional, or I would imagine even consumers, what are you projecting for the bond area for interest rate?
Right now, I think it's a question of whether the market is going to require bonds to pay more as we see more and more signs of inflation. But we're all taking a look at this demand supply crunch in the recovery and trying to decide whether this is a temporary increase in prices due to a lack of supply and manpower, or whether this is real inflation that has to be priced into the market.
So again, we don't know when, we don't know how, but historically, this has been the trend.
And I think everybody can look at what they buy every day and they can show the inflation in the prices of things that they're buying now. Look at gas prices, look at my grocery prices, look at the meal in the restaurant. And we may know that the meal in the restaurant is because they don't have enough workers and servers and their supplies are backlogged. And so they're having trouble getting supplies. But is this going to be baked in the cake? Are we going to have a longer term inflation? And it's important to know this as a point of reference.
So another thing too is that we have large stocks and small stocks. So when you're putting a portfolio together and people are spending a certain amount, why is this important to us?
My gosh, look at the additional return that stocks give you, whether they're large or small, over and above inflation. If you could get 7 or 8 points or 9 points above inflation, you would be able to see your money actually not only working for you, but growing, giving you a raise every year, which is exactly what you want, especially in retirement.
Well, what is when the arrow points down, what does that mean? Or not, when that line goes down?
Yeah, we don't like it when those lines go down, but that really shows the volatility of the market, how stocks or bonds, and we can see there's a big spread, but you can see that especially in that dark blue line, you can see when the market has gone down and it takes a while to recover. So it's important to be diversified so that you're not relying just on one category of investment to get you by.
And look at that red line on the bond side. It's a lot smoother than the stock side.
It's definitely a lot smoother, but I'm not making, I mean, at one point it looks like in the 70s, I'm not even keeping up with inflation.
Yeah. Okay, let's go back. But this slide is really important for everybody to understand.
Yeah.
All righty, so we talked about market capitalization. Again, for your own portfolio, find out and categorize, put a pie chart together. We'll go through that in a second, but put percentages. What percentage do you have in domestic? What percentage do you have in international? What percentage in international do you have in emerging? What percentage do you have in small cap? What percentage do you have in mid cap? What percentage do you have in large cap? You cannot figure out a properly diversified portfolio without knowing those things. And that is much more important than figure out whether or not you should buy or sell Apple stock. Let's go to the next slide.
Yeah, so I think as we've been working through this, we first want to determine to put together an asset allocation or a portfolio. And I don't know if
asset allocation, now that's a new word.
I was going to say, we haven't used that term.
No.
So that's really how much you are putting in each category of investment, how much you're allocating to large.
But the overall asset allocation,
yes.
How does that stated?
We typically state it as a percentage starting with stocks versus bonds. So if you had a 60-40 portfolio, it would be 60% stocks and 40% bonds.
I think we need to know what our asset allocation is, like we do our birth date, like we know our tax bracket, like we know our net worth. But most people don't know their asset allocation. Because does asset allocation determine what kind of performance we have?
Absolutely. And it also importantly determines how volatile your portfolio is going to be. Clients have sometimes just mildly, safely satisfied, just let things grow and grow and grow. They may have started out with a 60-40 intent, and that's how they set up their investments. And then they come to me 2 years later, and now they're 85% stocks and 15% bonds because the stocks really grew. Now they were very happy to let them grow. And when I say, well, maybe we should dial it back to 60-40, they're like, well, do we have to do that now? We're having such a good time. And I'm like, well, you won't like it when the market goes down. You know, you won't like it.
Determine the asset classes to be used, make a pie, implement, and
rebalance.
What does that mean?
That means that you take a look at that plan that you put together, and if they've grown out of your intent, that 60% stocks is now 75. You need to sell off some stocks and buy some bonds to get it back in balance to where you intended it to be.
So one of the things is that we need to understand how you're spending, how much you're spending on an annual basis. So do you need a 3% return, or do you need over a 5-year period somewhere between 8 and 12% return?
And this is an interesting issue because sometimes people will say, well, I don't like volatility. And then I'll take a look at their plan and I'll say, but your spending says that you need the growth that comes with stocks. are, you're going to have to take more risk, or they could cut back on their spending.
There's no free lunch.
I hate that part.
Yeah, but that's how it ties in to your net worth, how you spend, how much risk do you want to take. It's kind of a reality check. And when you do a financial plan and put a portfolio together, do you put hey, this is the likely scenario, this is a downside scenario, this is an upside scenario?
Exactly. And when we put that into our financial planning software, the software actually also gives us kind of a rating, of what are the odds of success. It's called a Monte Carlo analysis. But yeah, we're trying to decide how likely it is that you're going to meet your goals and objectives. Exactly.
And so when you say rebalance, what do you do?
We take a look at what our intent was. If our intent
The asset allocation?
We take a look at the asset allocation for each category of the asset class. And then we take a look at what's grown too large and what's grown too small. And we shave off some of the top of the ones that are overgrown, just like you prune a garden. And we buy more in the things that have not grown as much. And
Delia, am I hearing you right? That you sell your winners?
I know, and it just breaks our hearts. It really does. But you have to keep things in balance. I had a client come to me once and I was talking to him first about his risk tolerance. And he said, I don't know how much risk I want to tolerate until you tell me how much risk I have to tolerate. So it might be that, we're getting ready to rebalance and we may rethink the client's plan. We need to revisit the plan to see it. Do they need more income now? Do they need less? Maybe we can rebalance. Have they changed their goals otherwise? But rebalancing means you sell your winners and you buy your losers.
A question for you in terms of how you set up these plans. If I knew, for better or worse, that at most I'm going to live 10 years, probably less, whatever it may be, should I therefore be less conservative, more conservative? What should I do if I know that I have a relatively short life expectancy?
What's your net worth?
We're still wanting to know what your end goals are.
Yeah.
Good.
Yeah. Are
Right?
you planning on leaving the maximum amount of money to your children?
Or writing the last check and going
And it
away?
bounces.
Yeah.
Right.
That's why.
The answer always is it depends, isn't it, Pete?
Yeah,
Well,
it's all individual. It's not a mass market type of
Thank
thing. It's why your financial advisor can't not have over 100 clients. That's the way I think anyway, because it's so individual.
Absolutely. Some clients are willing to spend down their house to take care of their last years, and others are like, oh no, I'm going to use that. I want my kids to inherit that house.
Yeah. So if we knew exactly the age you're going to die, it makes it certainly easier because now we have a solid number to divide things by. But we need to know a lot more than just how many years do you have left to live. Let's see. Let's go to the next slide. Oh, one of the things before you get into the slide, because I think that slide is really important. No, let's go to that slide anyway. One of the things that you do as a financial advisor is to try to hit the sweet spot.
Yes.
I know what that means in tennis, but I don't. Explain what that means in your line of work as a financial advisor.
In my line of work, what this pictures and that sweet spot is to give you the maximum amount of return for the lowest amount of risk. And the risk that you feel comfortable taking, which might be different than somebody else's level of comfort and risk. So in this example, some people may think that 100% bonds sounds a lot less risky than putting stocks in a portfolio. But what this chart shows so well, when you think the bottom scale going across horizontally is risk and the vertical scale is rate of return on your money, that the minimum risk portfolio during this period of 1970 to 2018 would actually be a portfolio of 33% stocks and 67% bonds, meaning risk is volatility, fluctuation, or a new term, beta, plus or minus an index. But just think fluctuation, that's what risk is. The risk is two things, the volatility and the chance that you would actually lose money. I could tell, if I had a crystal ball and I could tell people you're absolutely going to make a great return, but that portfolio is a wild ride. I have a lot of clients who would step off the ride. I can't take this ride. Oh, but
Yeah.
you're going to get great returns. Nope, I can't take the ride.
Yeah, and every single period is a little bit different. So today, I'm hearing financial advisors more pointing to a 70% equity portfolio and a 30% fixed income portfolio for the next 5 years because of the bond market. So each period of time has its own risk versus return, because this is looking backwards. And so this is the kind of a portfolio that was a sweet spot during this period of time.
If we'd only known in 1970 that that's what we should have done, right? So this is one of those academic models that says, look what we figured out. And it's like, great.
Look at the 100% bonds.
Yeah, yeah. It has the most risk and it does not have, it's got the lowest return, absolutely lowest return.
Yeah. Okay, let's go to the next slide. This is the pie chart.
This is the famous pie chart. Investors always have to have a pie chart. This is an example of a 60-40 portfolio.
And the definitions kind of change, but generally this is considered a moderate growth portfolio because the asset allocation is greater than 50% in equities.
Yes. Yes, and you can see where we have a mix of different asset classes and categories of investments. We have large, medium, and small cap stocks. We have emerging market stocks and international developed stocks. And not only do we have US bonds, but we also have some emerging market corporate bonds.
So it's important to know your own portfolio. US large cap stocks. What index fund would represent US large cap stocks?
Standard & Poor's 500 is the classic.
How about the US mid cap stocks?
That would probably be Russell 1000 for small and mid cap.
Yeah. Yeah, so small cap, Russell 1000, Russell 2000, that would be that category. We're not going to go into the emerging and the core, but why is it important to understand what index is in what category?
Because you may not realize how your performance is going to turn out if you don't realize what you've invested in. You think you've got a core bond fund, and really you've just got one section of government bonds. Well, that's not going to act like the whole core bond market. So you may be misunderstanding what direction you're going in.
So when we hear, hey, the market's gone down 200 points today, is that relevant to our portfolio?
Only if you're 100% in that particular market.
And when they say the market has gone down 200 points, what are they usually referring to?
Oftentimes the S&P 500.
I thought it was more likely the Dow.
You know, it really depends on what news group it is. So the Wall Street Journal news is probably going to say the Dow. But you know, that's only 30 stocks. I mean, It's so silly.
It has no relevance to most of our portfolios. And they talk about it like, oh my gosh. And the adjectives that they use, you know, it's a tumble, or it's shocking, or it's just.
Well, how else are they going to get you to listen and buy whatever their advertisers are selling, right? Yeah. They have to put all this drama on it.
Yeah, and there is no one's portfolio that I know of that's 100% in the Dow or in the Standard & Poor 500. Let's go to the next slide. What does this mean?
So here's an example of how you could allocate, you could put together a portfolio, you could put together an asset allocation that is designed to give you either an increased return or reduced risk, or maybe a little bit of both, depending on what your goals and objectives are. So the first one on the left is typically where people come in where they say, I want to be really safe. I'm really afraid of stocks. They consider stocks are the boogeyman. And so they say, I want 85% stocks, that's the biggest portion, and 15% cash, and that's where I want to sit. Well, if we look again at this same time period of between 1970 to 2018, we would find that the average return of this portfolio would be 7.2% a year, but the volatility, the risk of this portfolio would be plus or minus 7.7%. This portfolio could go negative. And nobody likes that. They never complain to me when they make more than they expect to make, but they definitely are unhappy if they realize they're going to go negative. So one way might be to take a look at what that client has identified as a goal, which is a rate of return of 7.2, and say, what if I could give you that rate of return, but I could lower the volatility? Well, who doesn't want that? I mean, I want the great taste of See's candies with, none of the calories and sugar. Yeah, that's what I want. So in that middle lower risk portfolio, you can see that the return is very similar at 7.3, but we've reduced the risk. The volatility has gone down to 5.4%. And we've done that by, oh my gosh, we've added 20% stocks. We reduced bonds down to 39. And for this time period, they increased cash to 41%.
It's almost counterintuitive.
Absolutely. Absolutely.
That's why when we say you should never, we'll talk a little bit more about that in week 8, but don't listen to your gut when it comes to investing. It just doesn't make any sense. A diversified portfolio will give you a lower risk, more than likely a higher return. Well, let's look at the higher return portfolio.
Yeah, now here's the irony. If the client's taking a look at this and say, well, I wasn't that unhappy with that risk of 7.7% plus or minus. Could we optimize that mix? Could we make it even, could we juice it up and still stay in that same risk area? And yes, here we have a risk of 7.8%. We've taken bonds to 59%. We've increased stocks to 32% and lowered the cash down to 9%. And here's a client who's getting the same ride, the same volatility, but they've been able to squeeze out a higher return, more protection against inflation, just by how they allocated their portfolio.
And that's the sweet spot.
That's the sweet spot to me. Although some people might be most happy with the center one. They might feel even better, right? It depends on how they feel.
But this is really boring. I mean, you can just once you put your portfolio together, and then you don't need to do anything on the day-to-day basis.
Right. I've had you need to keep it in balance. You need to have some way of measuring it. But I mean, it's a lower risk portfolio. You're making your return. You can go and have lunch with your friends.
So the work is up front.
Yes.
Categorizing your portfolio, what you presently have, and then get it into your asset allocation that's good for you. Let's go to the next slide.
So this again is where we have the Ibbotson chart, just to remind us. If we go to the one after this, then we've touched on annuities.
Yeah, and then basically, as far as annuities is concerned, they're for individuals who need that security, that don't like the volatility, but there are so many fees in here, commissions. Not only that, in addition to that, it doesn't give you any kind of inflation protection. And does annuities give you capital gains income?
No, the irony is that you could be taking taxable money that you could, if you managed it correctly, you might be able to manage it for very low tax impact, for maybe paying advantageous capital gains. and you take that money and you transform it into ordinary income by putting it into an annuity.
Yeah, one of the things that
I do have to say, commercial annuity,
yeah, I know.
not a charitable gift annuity. Pete makes me, I have to tell him this every single time. I understand annuities, but when we talk about charitable gift annuities, it's a different animal, different beast. So I'm
We
trying to
did
be
a,
protective.
Yeah, we did a charitable presentation yesterday in Orange. People were just blown away by the benefits of a charitable gift annuity.
Oh my gosh, I've seen those charts of what you earn by your age. They're fantastic.
Yeah, and it's a 2-page contract. Nobody makes a commission. You're helping a charity out. Thank you, Don, for reminding me. A charitable gift annuity is a completely different animal than a commercial annuity, but it is a fixed income instrument. And it does not give you inflation protection, but it is a wonderful way to make a gift. Let's go to the next slide. Income taxes. Gee, one of the things that I don't see even with fee-only advisors is to give you the after-tax return. Is that because it's so difficult to do that for each individual client?
It is on a global basis. So for example, we were probably going to quote you or recommend municipal bonds and give you the after-tax or the effective tax rate for you based on your general tax bracket. But I can't tell you for the entire portfolio from year to year unless I know what your tax year was like.
So, but you need to understand the person's tax situation.
Oh, absolutely. There are clients before I would buy them bonds in a taxable account. I need to know what their marginal tax rate is. I need to know if I bring in another dollar, what that's going to be taxed at.
I have a client's portfolio that invested a lot in limited partnerships.
Wow.
The CPA is charging triple the amount for doing your taxes. That's one. Two is we never get the K1 on a timely basis. And it is so difficult to figure out what the return is.
And most brokerage firms these days won't hold them in an account unless you pay a fee every year for it. So there's another fee.
So you need to look at total return. What is your after-tax income? And that's another reason why a lot of times annuities are so poor, is because the total return is low. What do you mean by not everyone should own muni bonds? Come on, I mean, it's tax-free income.
You might be in a really low tax bracket. Now, if you are in a really, really low tax bracket, it's pretty easy to do the math to show you that you would be better off with a little higher or even the same interest rate, but usually a higher interest rate on a taxable bond than a tax-free municipal bond.
As
you
I
would realize a higher rate of return.
Yeah, I understand today you'd have to be above the 24% income tax bracket in order for muni bonds to make sense for you.
Sure, but I mean, luckily I have a lot of those clients.
Yeah. What do you mean by mutual fund distributions?
A mutual fund, as I'd mentioned earlier, if they are actively managed, they are buying and selling and buying and selling. And as a mutual fund under law, if they make a profit, they're required to send those gains out to you to pay taxes on. So if you own an actively managed mutual fund in a taxable account, right around this time of year, you're looking at it saying, oh my gosh, am I getting any distributions? Are they going to be taxed? How high are they going to be taxed? And you really don't know until you get to this time of the year. So those are best to put in retirement accounts.
So speaking of retirement accounts, is that what you mean by investment location?
Exactly. Exactly. Where do we have the money? What kind of an account? Is it in a taxable account? Is it in an IRA? Is it in a Roth IRA or 401k, 403bs? We can make the most of your investments and have the least amount of tax impact if we strategically place investments in those accounts to make the most of your investment without having a big tax bite.
Okay, my portfolio is 70% equity, 30% fixed income.
And you have 5 minutes to talk about it.
Okay, 70-30 portfolio. Where should I be putting, more than likely, where should I be putting that 30% bond portfolio?
If you're in a higher tax bracket, we're putting that in a retirement account.
Okay.
So that you're not paying taxes on that money until you need it and decide to take it out.
So I shouldn't be worried about making sure my IRA account is 70-30. I should be looking at the overall, my investment portfolio, making sure that is 70-30.
That's right. Most people care most at the end of the year about what that tax bite is going to be.
And Roth IRAs are completely kind of different than regular IRAs, right?
They are so different in that if you've had it for 5 years and you're older than 59 and a half, you get to take that growth out tax-free. I mean,
if you think you got high performing investments, that's where you ought to be putting in the Roth.
that's very exciting, and it's a great thing to inherit too.
Yeah. Annuities, tax inefficient. We want capital gains income out of our portfolio.
If it's a taxable account, of course, but you know, if some people have annuities inside a retirement account, it has the same tax impact.
Let's go to the next slide. I think, are we getting, what's,
So this is just pointing out that if, you know, taxes can significantly reduce returns. Are there any questions, Don, that we should be sure to cover?
One is, I would probably take you to your last slide. So there's contact information for you, which I'm going to guess might be on the left. No, it's not.
No, it's the
actually.
first slide.
Okay, let's go all the way back up to the top. There you go. That's a good one.
yeah, you know,
There's if you want to click on Q&A down there where it says 1 down below, I'm going to let
Yes.
you read the question to see if you can answer it. It's
Can you clarify capital gains taxes? My MJR tax income,
married joint return.
married joint return without capital gains is in the 22% marginal tax bracket. If I also had 50,000 in capital gains, would that not be subject to capital gains tax? As in, well, that's just the slide that I had up, that 0 to.
Yeah, and the answer is no. But neither one of us are CPAs who do tax returns. This is a great question, Jim, to ask your CPA. And the reason why that's so important too is that we're getting close to the end of the year. So your financial advisor and your CPA ought to be talking to one another.
Yeah, this is
and they should be talking during the year, not when you go see them in February to do your tax return and it's too late.
Exactly.
It's too late. This is the time of year when I go through taxable accounts with clients and we think about rebalancing and maybe selling some things at a gain and offsetting some of those gains with selling things at a loss, so
Right.
that we neutralize or zero out the tax impact of those changes.
But great question. So, but that's a CPA question. Do you, Delia, have a minimum for your clients?
No, I don't.
Yeah. So Delia is one of the few financial advisors in the Orange County community that does not, but there are others like Delia that don't have a minimum. For those individuals who didn't hear your first session on fees, briefly talk about how do you charge?
When I do hourly financial planning, I charge $275 an hour. The majority of people spend somewhere around 1.5 to 3 hours with me. And to prepare for that meeting, I also charge typically $150, depending on how complicated your situation is.
Why don't you stop sharing? Why don't you stop sharing?
Oh, all right, great.
Your first meeting, do you charge for that?
No, if they want to come in and talk about how we might work together, there's no charge. I'm not giving them a financial plan, but we can certainly talk about how we might work together.
Yeah, and so they should bring their brokerage statements in.
Bring the
maybe a tax
statements, if you
return,
put together a
and
net worth statement.
Yeah, so you
Absolutely.
can have a discussion.
Absolutely.
And would you be willing to answer any questions either by phone or email
Sure.
after the session is over?
Yeah, absolutely. Reach out, as you said, by phone or email, and certainly.
Delia, you did a wonderful job.
Thank
Thank
you.
you so much.
Well,
Thank
it's
you very
always
much.
fun.
Thank you
Thank
very
you.
much. We are at the end of today, and next week we're going to do medical care planning. And that's where we'll go in the session next week. I thank you all very much for participating. And I'm going to stop us now and turn off the recording.